let's have a look at cash flow statements. Cash flow statements are going to summarize the cash transactions of a business for a given period of time. They're going to show the cash the business paid to buy assets or pay their expenses, as well as the cash that they received from the sale of their outputs or any other business assets they sold over that period of time. Put simply, they show the movement of cash in and out of the business. It's worth noting at this point that although there aren't that many calculations associated with them, and there's certainly no ratios associated with cash flow statements, they can and do appear in the HSC exam. You can be asked to calculate opening and closing cash balances, or they could be there as a stimulus for a strategies-based question. Features of a cash flow statement. First of all, just like an income statement, they're going to have for the period ending in the title. They're going to include a number of different classifications. First of all, we're going to have operating flows. These can be broken up into inflows and outflows. Then we have our investing flows. These too can be broken up into inflows and outflows. Finally, we have our financing flows. These again can be broken up into inflows and outflows. The other thing that these statements will have are opening and closing cash balances. The opening cash balance is where the business started the month, and then the closing cash balance is going to be where they ended up as a result of the operating, investing, and financing flows over the period. Let's have a look at some key definitions. We've got a cash flow statement here for Keating's Kittens. Let's start with inflows. So inflows are cash coming into the business. And as you can see here, they can come from operating, investing, or financing flows. So this cash coming into the business could be as a result of selling the business's outputs, proceeds from the sale of non-current assets, or return from any financial assets that the business might have. Then we have our outflows. These outflows again could be coming from operating, investing, or financing flows, and they're cash going out of the business, and they're payment for inputs or purchase of non-current assets or any interest or financial costs paid. Another way that we can classify the things that appear on a cash flow statement are according to the type of flow that they're generating. We've got our operating flows. Operating flows can be cash inflows or outflows, but they're associated with making and selling the business's outputs. So an operating inflow is primarily going to be the proceeds from the sale of the business's outputs. However, your operating outflows are going to be things like payment for your expenses, paying your suppliers, paying your staff, etc. Then we've got our investing flows. Again, these can be inflows or outflows, but this time they're associated with the sale or purchase of non-current assets. So if a business buys a new piece of equipment or machinery, that's going to be an investing outflow. However, if a business had a building and it sells it, the proceeds that they get from the sale of that building will be an investing inflow. We've then got our final type of flow, which are our financing flows. These can be cash inflows or outflows associated with sourcing and repaying finance. So if the business obtains a bank loan or they sell more shares, the funds that they receive will be in a financing inflow. However, if the business pays dividends or has to pay interest on loans, that's going to be a financing outflow. However, we've had a look at a proper cash flow statement, but the HSC tends to use a simplified cash flow statement, probably a little bit more along the lines of a cash budget. This is how one's appeared in the past. As you can see, we've got cash in, which is going to be just our cash inflows, cash out, which is our cash outflows. Our cash inflows would be the total inflows from our operating, financing, and investing flows, and our cash out would be our cash outflows as a total from our cash outflows in operating, financing, and investing categories. In this situation, the primary focus would be on calculating either the opening or closing cash balance. So you must know the following equations. First of all, it's probably more of a statement of fact. The opening balance of 1 month will equal the closing balance of the previous month. So if my closing balance in June was 1,000, my opening balance in July would also be 1,000. To calculate my closing balance, it's simply my opening balance plus inflows minus any outflows over the period. Let's have a look at a simple cash flow statement. Remember, they're a pretty simple statement, but the questions can get quite tricky. The first trick in this particular question, if we were asked to calculate the closing cash balance for June, would be that they've written down underneath the table the opening cash balance for January is 5,000. If you don't read and use this number, all of your calculations from the very beginning will be wrong. The second thing that you need to do is to avoid silly mistakes by writing down and showing all your working. Have your opening and your closing balance for each month so you can track your thinking and work back if you think you might have made a mistake. So let's try and work out the closing balance for June. To do that, we need to start way back at January. We know our opening balance is $5,000. It tells us in the question underneath. To that, we add our $6,000 inflows, which takes us to $11,000. We then deduct our $3,000 cash outflows, giving us a closing balance for January of $8,000. That $8,000 now becomes our opening balance for February. To that $8,000, we add our $5,000 of cash inflows, taking us to $13,000. We then minus the $3,000 of cash outflows, giving us $10,000 for the total closing balance for the month. That $10,000 becomes our opening balance for March. You get the idea. We keep working through by adding in our cash inflows and deducting our outflows to get the closing balance. The closing balance becomes the opening balance of the next month. And we work all our way through till we get an opening balance for June of 1,000. We add the $3,000 of inflows and then minus the $2,000 of outflows, and it gives us a closing balance for the month of 1,000. So in summary, a cash flow statement is going to show the movement of cash in and out of the business. It's showing the money we received from selling our goods and services, along with the amounts that we paid out in the form of expenses and purchasing of assets, etc. It's showing us what we received and paid rather than what we earned and owe. The features of a cash flow statement are going to be the inclusion of accounts such as opening cash balance and closing cash balance. We're going to have operating flows, we're going to have investing flows, and we're going to have financing flows. Both can be broken up into inflows, which are funds coming into the business, and outflows, which is cash going out of the business. The key equation that you need to know is going to be the closing cash balance, which is the opening cash balance plus inflows minus outflows.